Preserve your wealth with these two retirement strategies. Welcome, my name is Daniel McCluskey. I'm an industrial engineering graduate from the University of Illinois with a track in economics and finance turned entrepreneur dedicated to helping you take the stress out of your finances so you can focus what matters most to you. When it comes to retirement or our later years, unfortunately, a vast majority of Americans end up in a spiral where they do nothing but think about and worry about money. What if the market crashes? What if an emergency pops up? What am I going to do? The problem is they've generally spent most of their life putting money into retirement accounts, tax deferred accounts. They're ready to finally retire, but if the market were to crash, that could really mess things up. No matter what plan it is they go with, whatever financial advisor or strategies that they implement, they never seem to be fully at peace because they know at the end of the day, the market could crash. Is there any way to protect against this? Help people opt out of this constant stress? Absolutely, there's two ways. The second is my favorite, but we're gonna start first with fixed indexed annuities. Essentially what these allow us to do, and they are very complex products, there is a lot of nuances to them. They don't have to be though. On the surface, what we're able to do is take a retirement account, an IRA, a 401k, otherwise a qualified account that's in the market, that's subject to market volatility, might not be able to withstand market crashes. You can roll that into a fixed index annuity. And essentially what these are is what it's gonna allow you to do first is you're gonna have downside protection. So if the market does go down, you're not going to lose due to that. And if the market does go up, you're able to participate in those gains, but you're only able to participate up to a cap. So essentially what you're doing is you're going from having money in the market to being protected from the market downturns, but in return for that, you will cap your upside potential. That is generally what a fixed index annuity is. All the tax treatment, withdrawing before 59.5, all of those things are gonna remain the same, just as it was in the IRA or the 401k, but now you'll have the protection for retirement planning is different than at retirement planning. Now, the second way to protect from the market downturns, which is my personal favorite, is the indexed universal life. What we're going to do if you were trying to move money from the retirement accounts into one of these is you can't just do a rollover, but you can roll money out, pay the taxes, and then now that it's post-tax dollars, fund an IUL that has to be maximum funded to be able to serve similar benefits. The difference is with these, not only are you gonna have the downside protection, now the money is going to grow tax-free, you're gonna have full access to that money, tax-free when you die. It will transfer tax-free and blossom because it's life insurance. There has to be some insurance in there that it's going to grow to. And finally, of course, you have the downside protection and you're not going to be capped as low on the upside potential. So generally, they're going to outperform the fixed index annuities in the long term. Now, I have tons of videos going over the nuances of those, but the reason that I don't only mention that as opposed to the other one, even though I say that IUL is typically better, is because there is a number of scenarios where fixed index annuities just make sense. People aren't wanting to play with all the intricacies of a rollout. Fixed index annuities might make sense if you're really trying to add in the downside protection. If, for example, let's say you're 70 years old and you might need access to money or take immediate income in the next year or 2 years, well, the fixed index annuity might make more sense for you. If you have a little bit of wiggle room and you're not going to need that money for a few years, you might be able to consider IUL. Again, it just depends on your insurability, kind of what you need the money for. Even if you're uninsurable, a lot of times, for example, you can have a spouse, a parent, kids that can be the insured and that you can still reap the benefits from. Just because you're the owner and reap living benefits doesn't mean you need to be the insured. But those are the two ways that when it comes to protecting against those market crashes that I prefer the most in terms of opting out of market volatility. It's just very tragic to see so many retirees spending all this time worrying about money. They worked all their life to get to retirement. And now all they do is think about money. They'll get to their deathbed and just say, I just worried the entire time in all my retirement years, the market was gonna crash, if I was gonna have to go back to work, if I was gonna have to reduce my lifestyle. Something that I believe is worth opting out of, maybe even taking a lower average rate of return for some safety, because the most valuable thing you can have, especially in those retirement years, is your peace of mind, being able to free it up, focus on the things that matter. These are problems that you might struggle with in retirement and you do want to learn more. That is exactly what this channel is about. I release videos 5 days a week, so I do ask you to subscribe and I will see you in a future video.